Brendan Lyons from Perennial Private Investments. Welcome to the Alternative Symposium.
Thank you, Drew.
Could you expand on Perennial's approach to investing in private markets?
Yeah, we focus mainly on the late stage or private growth part of the private market through companies which have got a product in market, they've got customers and revenue, through to an IPO and beyond. Makes us somewhat different to other private investors. We're looking for companies that might make good public companies and looking to hold them through that whole process.
And what is the size and what do the companies look like within that universe of investments?
The size really comes down to the valuation and perhaps the revenue base of the business. We're not investing in startups, for example. So these businesses have 5 to 10 million in revenue up to perhaps 200 million in revenue. The valuations of the companies can be sort of similar. They can be sort of 50 million to 200 million. And we're looking to invest in them, help them grow and professionalise those businesses, and then IPO or exit them at much higher valuations.
And is that a highly competitive market for investors?
Where we play, it's not that competitive at the moment, especially in the last 12 months. We've seen a lot of the international funds who were in the Australian market perhaps 2 years ago have largely exited. There's a lot of people doing startups and early stage fund investment in Australia, and there's a few doing obviously IPO and pre-IPO investments, but in that private growth segment, there aren't too many competitors.
And what are some of the key benefits of an allocation to this part of the market in portfolios?
Well, I think it's quite unique. You're getting a chance to invest in domestic growth businesses, and these businesses which are growing their revenues by 50% to 100% year on year. They're growing much faster than listed companies. These are sort of the leaders of the future, founder-led businesses. Gives you an exposure in your portfolio that you're not getting from the listed equity market and you're not getting it from other asset classes.
What differentiates Perennial's approach, and how important is a long-term view in this part of the market?
Yeah, long-term view is important. We are investing over a number of years in these businesses. Our funds are structured that way, so it's different. There's different liquidity profile than you get, say, in listed equities or perhaps other asset classes. But I think one of our competitive advantages in this market is that we've been doing it now for over 5 years. We've got 6 funds that can invest privately. We've got one of the biggest capital pools doing this in Australia, a strong brand in the market and reputation. So as a result, we see a very large pipeline of opportunities. We're investing in well less than 5% of the businesses that we're meeting. That pipeline's continuing to grow as companies want to stay private for longer and get a lot bigger, and they're looking for an institutional partner that can partner with them all the way through, from private to IPO to public, and hold them as public companies, and that's where we differentiate ourselves.
And how important is your experience in maintaining deal flow?
Deal flow is critical. The more you see, I think the better decisions that you make. We're fortunate, having been in the market for a long time, that we have relationships with all the major counterparties, and we do a lot of our own outbound calling, as well as companies finding us directly. But I think our position in the market, the brand, the history of what we do at Perennial means that we often get first look at things, which is beneficial because it means you can cornerstone. You can do it exclusively. You can set the price and terms, and if there are others that are involved, then you're setting the terms and engaging with the company at a higher level. Okay.
Can you expand on one of your highest conviction ideas within the strategy?
Well, there's one I'll be talking about actually at the Inside Networks conference today, and that's a company called Complexica. It's based out of Adelaide. It's been running for almost 10 years. The founders are a third generation founders, so they've sold 2 businesses previously. It operates in the AI space, so what they've developed is a decision-making tool which helps large corporates with very complex business models. It might be a large number of products, it might be a lot of regions, it might be different price points, and so for a lot of salespeople. It enables them to ingest all that data and come up with solutions for that company of how to grow their product suite better. It's a business that's growing very quickly, very large blue chip customers, strong revenue and already profitable. And we see that's one of the most recent investments we've made at Perennial.
And what would be one of the single most important traits of a portfolio company?
We look for a few things. I think single most importantly, it probably goes back to the people. Investing alongside a founder, that they've got the right experience, that they're well aligned in terms of their equity holding in the company, and they've got the same objectives as you have in terms of where they want to take the company and over what time frame. That's absolutely critical. But it's also the business model and the investment case. Is it a business we're interested in, the size of the market, what's the growth rate, the financials of the company are obviously important. We also look at things like counterparties, like who else is involved, are there other shareholders before us, do they have an advisor, who's around the business, what's the board of directors look like. But I'd say the thing that, once we've done all that work, the thing that really is going to make a difference to the performance of our funds for our investors is the price and terms. Can we invest in this business on a good valuation with attractive terms to ensure that that we can generate strong performance for our client base?
And the biggest red flag for a company?
Someone who doesn't do any of those things. So essentially, the person who's not there for the long term, I think, in terms of a founder, they're not well aligned. Clearly, businesses which perhaps sound good and might be good private businesses, but could never become a larger public business. They're the sort of things we're filtering out for. And cyclical businesses. We don't invest in cyclical businesses. By definition, they're hard to predict in terms of their future revenue and cash flows. And so we're only investing in growth businesses, which we feel are easier to predict and hence value.
Brendan Lyons, thank you.
Thank you, Drew.